This is an analysis from Alpha Business Media. Welcome back to the deep dive.
Today we're zeroing in on a story of, well, massive potential and a terrifying bottleneck in South Asian energy. We're talking about Nepal.
A country that's sitting on what is essentially a hydroelectric gold mine.
Exactly. It's poised at this really tantalizing inflection point. The goal is huge. They want to become a regional energy powerhouse. We're talking exporting upwards of 10,000 megawatts.
And that ambition, not much as a theory anymore. The sources we looked at make it clear. The private sector in Nepal has responded ferociously.
How so?
Well, installed generation capacity is just surging. It's already pushing close to 3,000 megawatts, and it's rising, rapidly year after year.
Okay, that's tremendous progress. But here's the massive, almost invisible paradox we really need to dissect today. That rapid private sector scaling of power generation is running headlong into a colossal constraint, the lagging transmission infrastructure.
Right.
Our mission today, based on this hard technical and financial look at the grid, is really to help you, the listener, understand this deficit.
Because it's the central variable.
It's the central variable. It determines whether this whole boom translates into national prosperity or, well, a cascade of stranded assets and crushing state liabilities. We have to talk about the $3 billion investment gap.
And the true daily cost of what the research calls spilled energy.
Yes.
Okay, let's start right there. That core threat, spilled energy. It sounds almost gentle, like spilled milk, but it's a brutal term. What does it actually mean for Nepal?
Spilled energy is power that could have been generated but wasn't.
Why not?
Simply because there was no path to get it onto the grid or to export it. And for Nepal, this issue is particularly pernicious.
And that's because of their portfolio structure.
Exactly. Almost all their hydro projects are what we call run-of-river or ROAR schemes.
So for anyone not deep in power generation, why does that distinction run-of-river matter so much?
It matters because these ROAR plants are essentially slaves to the river's flow.
Slaves to the flow.
They don't have large reservoirs where they can hold water back and choose when to generate. They make power instantaneously based on how much water is moving.
And the water flows most during the monsoon.
During the summer monsoon season, yes.
Yeah.
So they're forced to produce maximum power during the wet season, regardless of whether anyone can actually use it.
So you can't store the energy, and you can't even store the water for later if you can't sell it right then and there.
You lose it. The potential revenue is just gone. And this creates a massive unevacuated surplus, precisely when they need to be earning their maximum export revenue.
And the numbers back this up.
Oh, they underscore the severity of the coming crunch. Domestic wet season demand is only about 1,800 to 2,000 megawatts.
But capacity is already near 3,000?
It is. And it's projected to exceed 5,000 megawatts by 2026. Without the export lines, a huge chunk of that surplus is just spilled.
That's where the revenue literally vanishes. Okay, let's translate that technical loss into what you called a fiscal time bomb. This is where it gets really serious.
The sources show the scale of the financial devastation. A conservative estimate, and I mean conservative, suggests that if just 1,000 megawatts can't be exported.
Which, based on the grid lag, sounds highly likely.
It is. That translates to over $1.2 million.
Wait, $1.2 million in lost revenue every single day?
Every single day. And that's assuming a minimal export price of just 5 cents per kilowatt hour.
So if that surplus grows to 2,000 or 3,000 megawatts, we're talking about annual losses approaching $500 million.
They absolutely could. And this is where the dangerous financial contagion begins. It affects every single player.
Because of the contracts.
Yes, the private producers operate under take-or-pay power purchase agreements, or PPAs, with the Nepal Electricity Authority, the NEA.
For those less familiar, just briefly, why is that take-or-pay clause so dangerous here?
So a PPA is a long-term contract where the utility, the NEA, agrees to buy power. Take-or-pay means the NEA is legally obligated to pay for that power.
Even if they can't actually take it?
Even if they can't physically take it or sell it. Exactly.
I see. So if the NEA can't export the surplus because the lines don't exist, they still have to pay the private producers for it.
Precisely. And this transforms what should be desperately needed export revenue into a massive contingent liability right on the state's balance sheet.
It's a systemic risk.
It is. If the NEA, the sole buyer of all this power, starts hemorrhaging money, its entire solvency is threatened.
And the NEA is the linchpin of the whole sector. If it looks shaky, that kills all future investment, not just in transmission. It's like the state is subsidizing the failure of its own planning.
That's the hard truth. You have to solve for the risk that the buyer won't be able to pay. Otherwise, this whole hydropower dream becomes a self-inflicted economic drain.
That paints a powerful picture. Okay, let's pivot to the physical fix. Public discourse, from what we've seen, focuses heavily on one project, the new Butwal-Gorakhpur cross-border line.
The NBG line, yes. It's a big 400 kV line designed for about 2,500 megawatts. It seems like the obvious solution.
But it isn't.
It seems like it, but the research insists that's a distraction from the real internal issue. It was a great analogy we found.
No.
The NBG line is the seaport. It's the gateway to India. But a seaport is useless if you don't have the national highway system to get the goods, the power to the port.
So the final valve is being built, but the entire piping system leading to it is incomplete. The real issue is Nepal's internal 400 kV transmission spinal cord.
That's it, exactly.
Yeah.
But we have to understand why that internal link is so crucial. Geographically, most of the new generation is coming online in the eastern and central regions.
Along rivers like the Arun, the Tamar.
Correct. That power has to be collected, consolidated, and then wheeled westward across the country to get to that Butwal export point.
And the existing lines, the smaller ones, just can't handle that kind of bulk transport.
Not at all. Think of the existing 132 kV and 220 kV lines as, rural roads. They were built for regional distribution. If you try to push thousands of megawatts through them,
You get bottlenecks, congestion.
severe congestion, and massive technical losses.
Yeah.
The electricity just dissipates as heat. You need the 400 kV backbone to move that bulk power efficiently.
And this backbone isn't just one project, is it? It's several core components that all have to work together.
It's a multi-year complex effort. You've got the Hitoda-Talkibar in Arua eastern segment, and critically, the delayed line funded by the Millennium Challenge Corporation, the MCC.
That's the one that links the area around Kathmandu out towards the Butwal export node.
Yes, linking Lapsefeti to Galchi, Damali, and Sinawal. It's crucial.
And the sources call this an interconnected failure risk. What does that mean?
It means the commercial viability of a power plant on the Arun River is now directly tied to the execution risk of the MCC line, a completely separate project.
So if the MCC line gets delayed by politics, the generator on the Arun is suddenly stranded.
They're stuck. They can't move their product. And that uncertainty, that's a massive deterrent to any major institutional investor looking at the entire sector.
It's a risk the developers can't control, but one that completely undermines their business plan.
Precisely. And this brings us to the financial reality. To complete this transmission backbone, this highway system, the estimated investment is a staggering $3 billion.
$3 billion. That's far beyond the capacity of the NEA or the national budget.
Way beyond. So it has to be foreign direct investment, but a very specific kind. The sources repeatedly stress the need for patient capital.
Okay, that's a critical term. What's the DNA of patient capital?
Think large institutional investors, pension funds, sovereign wealth funds, specialized infrastructure funds. They are not chasing the high-teen returns and rapid exits of private equity.
So what is their investment philosophy then?
They want stability. Predictable, low-risk returns over the long, long haul. We're talking 25 to 30 years.
So certainty is everything.
It's prized above all else. They need to know the rules of the game won't change after they've put billions on the table.
But the environment you just described, the shaky NEA, the political delays, that is not speaking the language of patient capital.
It's failing to. That's the core finding. The policy risk far outweighs the technical risk. The research highlights 4 primary risks that are scaring away this $3 billion.
Let's walk through them. First is the one we already touched on, revenue risk.
Right. The transmission line's only revenue comes from the NEA paying a tariff to use it. If the NEA's balance sheet is weak because of all that spilled energy.
Investors lose confidence that the NEA can pay its bills for 30 years.
Exactly. Why build a toll road if the only toll collector might go broke?
That makes the connection crystal clear. What's the second deterrent?
Regulatory risk. The fear here is political interference.
Okay.
An investor's entire 30-year model is built on a fixed formula. If the electricity regulator, under political pressure, changes the tariff structure mid-contract,
The whole model collapses.
it's destroyed instantly. For patient capital, regulatory integrity is absolutely non-negotiable.
And the third risk gets into the legal nuts and bolts of the deal.
Correct. The third is the TSA gap. TSA is the Transmission Service Agreement. This is the bankable legal document. It has to clearly allocate risks. For instance, who pays if land acquisition protests delay construction for 3 years?
You need that clarity up front.
And you need it to guarantee the revenue streams. Without a gold standard TSA, the risks are just too ambiguous for institutional money.
And finally, there's the currency exposure.
The dreaded Forex risk, yes. The investment is in US dollars, but the revenue comes in Nepali rupees. If the rupee depreciates over 25 years,
The investors' real returns get eroded.
they do. So they require mechanisms, maybe government guarantees or hedging, to mitigate that long-term currency risk.
So the policy mandate isn't just we need money, it's about engineering a specific de-risked financial architecture just for transmission.
That is it. Perfectly put. You need solutions that speak their language. Maybe an independent transmission system operator, a TSO, that ring-fences the revenues away from the NEA's other risks.
Making the revenue stream more secure.
Or targeted government guarantees to absorb the political risk that private investors just can't manage.
This analysis gives us two very distinct outlooks for the next, say, 12 to 24 months. Let's start with the one the sources call most probable, the muddle-through scenario.
If the current pace continues, and there's little evidence of a radical shift, we see the NBG export line delayed until 2028 or 2029. The internal backbone remains a frustrating patchwork.
Which means what in practice?
It translates directly into 3 to 5 years of significant and growing wet season energy spillage.
So those annual losses, hundreds of millions of dollars, they become a chronic reality.
A reality that will place immense, probably unsustainable strain on the NEA. It will almost certainly require sovereign bailouts.
Which creates a vicious cycle.
Exactly. A cycle of underinvestment, because no one wants to finance the next phase when the first is failing. It just guarantees huge economic uncertainty.
Now, for the alternative path, the optimal one, the coordinated push scenario, this sounds like it requires a radical, immediate policy shift.
It does. The government has to elevate the entire 400 kV backbone to a super priority national project. That means a high-level empowered body with single-window clearance to just cut through the red tape.
And that body must simultaneously address the financial deterrence.
Absolutely. At the same time, you roll out that attractive policy package for transmission FDI, the bankable TSAs, the government guarantees, the Forex mitigation. That's what's needed to lure patient capital off the sidelines.
And as that happens,
If that coordinated push is successful, spillage is largely averted, that $3 billion export goal becomes achievable, and Nepal solidifies its reputation as a reliable strategic partner.
what's the ultimate summary here? Because the analogy used in the source material really defines the problem perfectly.
The hard truth is that Nepal is meticulously building a portfolio of state-of-the-art engines, these new power plants, but is planning to bolt them onto the chassis of a bullock cart,
The transmission grid.
the transmission grid. This isn't an unpredictable shock. It's a policy and execution failure that's been visible for years. And without a radical shift, that hydropower dream won't be hard currency. It'll just be spilled energy, washing away potential profits.
So, to summarize the crucial points for you, the key takeaways are twofold. First, it's understanding that this financial devastation is caused by a lethal combination, the run-of-river project structure plus inadequate policy. That equals spilled energy risk. And second, it's recognizing the specific nature of the capital required, that patient capital, which demands a level of regulatory certainty that right now just doesn't exist.
And that leads to a final thought for you to consider. The source is clear.
Right.
This is not an engineering failure. It's a failure of policy and execution. And that raises a critical question for many developing economies. How can you incentivize policymakers to focus on low-glamour, high-impact, long-term infrastructure like transmission lines when all the political rewards are concentrated in the high-visibility, ribbon-cutting moments of new power plants?
Something to mull over. How execution risk so often outweighs technical risk in these massive projects. Thank you for joining us for the deep dive.